Good afternoon. Ladies and gentlemen, welcome and thank you for joining us virtually for today's annual general meeting of Crown Place VCT PLC. My name is Penny Freer and I'm the Chairman of the Board of Directors. May I introduce you to my board colleagues, James Agnew, Pam Garside and Ian Spence, who have joined me here at Albion's offices in London. You should be able to see all the board members on the screen. Emil Gigov, a partner of Albion Capital, will join us shortly to give a presentation on the company's results, and Will Fraser-Allen, managing partner of Albion Capital, will be joining us later. The AGM is again being live streamed over the internet to give shareholders the opportunity to take part in the proceedings. The quorum for this AGM is that 2 members entitled to vote in person or by proxy, and this has been met, and therefore I declare the meeting open. At last year's AGM, a special resolution was passed to change the Articles of Association to allow for virtual and hybrid meetings to be held when necessary. This was to allow continued shareholder engagement when face-to-face meetings were not possible. A positive impact of these virtual meetings has been that many more shareholders are participating in our AGMs than has historically been the case. We've adopted a slightly different approach to last year's AGM to allow shareholders to ask questions ahead of a Q&A session, which will follow the manager's presentation. May I ask that you use the Hopin chat function to send questions through to me now. To do this, go to the right side of your screen, click the Slido button, and you will be able to type your question there. I would like to take this opportunity to thank shareholders who have already sent their questions through to the Chairman email address. We will be answering a selection of these questions during the Q&A session. The board highly values our engagement with shareholders, and I do hope at the end of the AGM, you will also give us any feedback that you may have, again, using the Chairman address. As is customary with all our company AGMs, we're going to start with a presentation from the manager. I'm going to pass over to Emil.
Thank you, Penny. Good afternoon. My name is Emil Gigov. I'm partner at Albion Capital. I'm delighted to be here with you today to deliver the management presentation in the results for the year to 30th of June 2021. May I have my next slide, please? This is the agenda for today. I will start talking about the financial highlights, the track record of the company, and the highlights of the year. I won't dwell over that in too much detail because you've all received the report and accounts for the year. And if you haven't had those, you can access them through the Albion website. I will spend most of the time of this presentation talking about the investment portfolio and the new investments we have made, the realizations we've achieved during the year, as well as briefly speak about the investment strategy, the ESG and responsible investing criteria we apply to our investment strategy, and then finish with the prospects and the top-up offers for the 2021-22 tax year. Next slide, please. The financial highlights for the year to 30th of June 2021. I'm pleased to report that the company achieved a total uplift in opening asset value of 15.9%. This represents an increase in total return of 5.26 pence per share, and the net asset value at the year end was 34.79 pence per share. Shareholders also received dividends in the form of the normal tax-free dividend of approximately 5% of net asset value. In addition, they received a special dividend of 2 pence per share. In total, dividends paid to shareholders were 3.61 pence per share. Next slide, please. We often get asked about the impact of COVID-19 on the portfolio and also on the way that we manage the company, we manage the VCT. The bigger question here is about the portfolio, to my mind. We are now approximately 18 months into this pandemic, and it is fair to say that for a number of our portfolio companies, the effects of COVID-19 are easing. A number of the companies are used to operating in this new environment. Most of our companies operate in sectors such as software, fintech, and digital health. Many of them have had a boost in growth from this drive for companies in the economy to become more digitalized. So we've seen a number of our portfolio companies actually benefit from this new environment and accelerate their growth. At the same time, there's a number of challenges still ahead of us. Those are challenges not so much for our portfolio companies, but possibly a second-tier challenges for their own customers. We're seeing challenges in terms of companies being able to access talent to increase their growth. We're seeing challenges in terms of companies being able to manage their supply chains. All of these have been well reported in the press. In terms of our engagement with shareholders, what we have found, having staged a number of virtual meetings to date over the last 12 to 18 months, is that this has increased the participation of shareholders by something like 150%, which we think is a positive. Nevertheless, we recognize that many of you would prefer to have a face-to-face interaction, especially with us, with the manager, as well as with the boards. And for those of you who can, we are staging the annual shareholder conference this Friday in London. We have also used this opportunity to automate and digitalize our fundraising process. Last year, we adopted exclusively a digital channel to raising funds for our venture capital trusts. And by all the feedback that we've received, this has been extremely encouraging and very positive. Next slide, please. Now, you may have heard us say on a number of occasions that we consider venture capital trusts to be a long-term investment product. Therefore, when we look at our returns and we judge our performance, we look at the longer-term horizons of 5 and 10 years. As this chart shows, over the 3-year horizon, the company delivered a return of 26.6%, over 5 years, 60.3%, and over 10 years, the increase in net asset value in total return was 75%, or 7.5% per annum on average. These returns are shown before tax relief, so shareholders who have subscribed have enhanced their returns through the tax relief available in subscription for VCTs. Next slide, please. Now let's move to the highlights of the year. This slide compares 2021 to the previous financial year. As you can see, the fundraising amount raised by Crown Place VCT of 9 million was over doubled what was raised in the previous year. In what was generally a challenging year for M&A, we achieved exits of 12.3 million pounds, pretty much similar levels to the previous year when we had some chunky exits as well. Our investment rate more than doubled from 4.2 million to 8.3 million. Share buybacks were 1.6 million compared to just under 1 million in the previous year. The dividend payout, due to the special dividend of 2 pence per share, increased nearly twofold from 3.8 million to 7.3 million. And cash at the year end remained broadly static at about 35% of net asset value. Next slide, please. In considering the highlights of the year, we have looked to see which companies, which investments, and what activities contributed to the increase in net asset value and total return. The sale of our care homes at above the book value contributed approximately 1 million pounds. Gains from other exit contributed approximately £500,000. The 3 key investments in Quantexa, Oviva, and Provica delivered significant uplift. In the case of Quantexa, this was driven by a Series D funding of $153 million, which was led by a large private equity growth capital type investor, Warburg Pincus. In the case of Oviva, the increase in valuation was driven by a Series C funding round where new investors, Sofina and Temasek, contributed to an 80 million fundraising. And Provica increased in value by approximately 1.1 million, which reflected strong growth in terms of trading. Other write-ups, as detailed in the annual report on pages 26, 27, and 28, contributed just under £5 million. But against that, we had a few write-downs, most notably in Mirada Medical and Evora. Mirada Medical is a company that sells to hospitals, and during this period of the pandemic, it was very difficult for it to get access to its customer base. And Evora is finding some challenges in terms of its trading environment. Next slide, please. And when we look at the portfolio, We look at it, diversification. As you know, the portfolio has been well diversified over a number of years. We currently have circa 60 companies that we have invested in, which employ in excess of 3,000 people, most of those in the UK. The key sectors represented in the portfolio are fintech, with approximately 20% of net asset value, other software and technology, and this is principally business-to-business type software technologies, approximately 13% of the portfolio, and healthcare, which is currently approximately 17% of the portfolio. This is post the disposal of the care homes during the year. In addition, renewable energy assets, which we hold and which generate useful income to the company, are approximately 10% of the net asset value. As you can see in this chart, and the figures in the brackets represent the relevant percentages from the previous year, we have increased our exposure to sectors such as fintech and software. Healthcare has decreased slightly due to the sale of the care homes, while renewable energy has remained broadly the same. Cash and net assets have remained broadly the same at about 35% of net asset value. Next slide, please. A different way to look at the portfolio is to look at the maturity of the companies that we've invested in. If you take the graph on the left, this graph shows the stage of maturity of the companies in the portfolio. We classify this in three different subgroups: early stage, growth stage, and scale-up stage. Early stage, we classify those companies that have less than £1 million of revenues. In the growth stage are companies of between £1 and £5 million of revenues, and in the scale-up stage, companies with over £5 million of revenues. Again, the figures in the brackets represent the relevant proportions in the previous year. What you will note is that a number of the companies that were previously in the growth revenue stage have moved on to the scale-up stage, i.e. grown in size and valuation as they progress towards their maturity. A similar picture can be inferred by the graph on the right, which maps the number of employees, the average number of employees that those companies have on their books. As you can see, the number of companies that now employ between 50 and 100 people, and those that employ in excess of 100 people has risen over the year. Next slide, please. Let's have a look at the three biggest companies, the three biggest investments in the portfolio. The three together represent approximately 22% of the net asset value as of the year end. The biggest one by some margin is Quantexa. Quantexa is a software company that uses entity resolution technologies to generate networks and advanced analytics to support a number of use cases to its customers, predominantly in the banking, insurance, and government sectors. Quantexa was a company that we backed very early on in their development, almost soon after the startup stage back in 2017. Crown Place had invested £1.8 million to date, and the book value is in excess of £10 million. During that period, revenue has grown 11 times, and employee growth has been significant, from approximately 23 at the time of investment to over 400 today. Provica is another exciting company that specializes in developing pharmaceuticals focused on children's health. Crown Place invested £1 million starting back in 2012, and currently the investment is valued at just under £4 million. We invested pre-revenue, and now the company generates in excess of £10 million of revenue, and employees have grown from 4 to 45. The third largest investment is one of our renewable energy investments, the hydropower investment called Shonay River Hydro in Scotland, where the company invested £1.5 million, and that's currently valued at just over £3 million. Next slide, please. I'll now talk you through a series of new investments which we've made during the year. This was a busy year for new investments, despite the initial hiatus due to the pandemic. One of those very exciting investments is Solidatus, which is a software company that provides data lineage and metadata management solutions to its clients. In effect, their software empowers organizations to effectively map and manage data across multiple complex systems. A number of their customers have hundreds, if not thousands, of software systems that they utilize across their global businesses, and Solidatus enables them to discover data, make sure that data is properly managed in terms of regulation and compliance, and that they can benefit commercially from the data that they hold. Albion VCTs invested 7 million as part of a 14 million investment round. Crown Place invested 1.2 million of that. And the investors who joined us in this round included HSBC Ventures and Citi, two of the company's major customers. As is the case with a number of the investments we make, the funds will be deployed to expand their talent base, to recruit more people and expand into new geographies, predominantly in the US. Next slide, please. Another very exciting investment is WeGift, which is a cloud platform that enables corporates to purchase digital gift cards and distribute them to employees, partners, and customers. Gift card incentives are a very big business. There's a very large market in that, and a number of companies are using very sophisticated programs. And in many cases, those programs are managed in a very traditional way through lots of paper and spreadsheets. And WeGift is enabling those customers now to digitize all these operations and enabling them to be more effective and efficient in how to do that. The Albion VCTs invested 4 million as part of a 6.7 million investment round in WeGift, and Crown invested £800,000. Next slide, please. Another very interesting investment in the software space is Gravity. Gravity provides open source application program interface management platform, or API management platform, that enables enterprises to manage their APIs through their lifecycle. For those of us who are not particularly tech savvy, APIs are the technologies that couple software systems so they can actually speak to each other. And as companies become more and more digitized and rely on both external and internal software systems for the day-to-day operations, the APIs are getting ever more complex and sophisticated. Gravity helps its customers to actually manage those KPIs and ensure there's no breakages. Albion invested £4 million, leading a 7.5 million investment round in Gravity. Next slide, please. There are 4 more companies which I'll just mention rather than speak in detail about. 2 of them are in the health tech side, Nuvo Air and NewMed, both very exciting companies, one in respiratory conditions and the other one enabling life science organizations to conduct medical research. And Brightlead and Southern, 2 business-to-business software companies that have unique propositions. In the case of Brightlead, using graphics processing units to enable very fast real-time databases, and in the case of Southern, a company that enables the rapid production of machine learning models. Next slide, please. Now, in a reasonably difficult year, for a year full of uncertainty for the M&A market, specifically, we managed to deliver quite a number of exciting exits. By far, the biggest one in terms of cash return to the funds and to Crown Place was the sale of the care homes. Our 3 care homes, Active Lives, Ryfield Care, and Shinfield Lodge Care, were held in the portfolio for approximately 6 years or so. This company invested £5 million at cost and returned a multiple of 2.5 times cash on cash and a 20% per annum internal rate of return for what was a reasonably secure asset-backed, property-backed investment ungeared. The exit was to Corian, which is a leading European, mostly French and Spanish-based care services group, but with also operations in another 7 or 8 countries, who were looking for a beachhead in the UK, and they had identified our care homes and some of the others run by Berkeley Care Group as the ideal first step to expand in the UK market. And this gave them the confidence to complete this transaction in March of this year at a very difficult time in terms of the pandemic and a very difficult time for the sector. We achieved excellent mature values for our investment, which reflects really the quality of the companies and the operations that we have developed. Next slide, please. We also realized the investment from G Network, which was our central London full fiber broadband network. This company invested 600,000 into G Network and delivered a return of 3.8 times its original investment, 31% per annum internal rate of return. G Network has grown dramatically during our ownership, having taken significant funds from further investors, including most recently from the University Superannuation Scheme and Cube Infrastructure Managers, specialist infrastructure equity and debt provider, who together provided in excess of £1 billion to refinance the operations of G-Networks. At that stage, it was appropriate for our funds and for Crown Place to exit the investment at a good return to shareholders. Next slide, please. We also exited our investment in ClearReview. ClearReview was a software company providing employee performance management solutions to its customers. It was £200,000 invested from Crown Place VCT, which delivered a return of 2 times, just over 2 times, and a very strong internal rate of return of 73%, which mostly reflected the short holding period of 15 months. ClearReview was exited perhaps earlier than what we expected in the investment process, and this was driven by a significant and very attractive offer received by a third party, which ended up acquiring the company, Advanced Computer Software Group. Next slide, please. We also exited our investment in SBD Automotive. Again, the cash-on-cash multiple delivered was just over 2 times, 26% per annum internal rate of return. Next slide, please. Prompt delivered a similar return of in excess of 2 times cash-on-cash multiple, 17% per annum internal rate of return. The company was acquired by Alemico, which is a leading supply chain connectivity business. Next slide, please. Now, I would like to spend a minute or two talking about our investment strategy. Hopin invests at 3 stages of the companies that we back of their development. These are seed stage, Series A stage, and Series B stage. What do we mean by that? At seed stage, we expect companies to have developed products, but to be still commercializing them and having revenues usually less than £1 million. At Series A stage, companies will be having some traction in the market with their products and generating revenue somewhere between £1 and £5 million. At Series B stage, company which is much more mature, typically with 100 employees plus, and generating revenues in excess of £5 million. We're backing long-term trends and principally across software and healthcare technologies. Such long-term trends are exhibited in the subsectors of cybersecurity, digital marketing, data analytics, fintechs, to name but a few. And in healthcare technologies, we see those in healthcare IT, in specialist pharma, diagnostic devices, and others. We also invest in other areas more opportunistically, and certain areas where we've invested successfully in the past include automotive technologies, sensors, and process automation. Our focus is on business-to-business software and technology-enabled services. We rarely invest in consumer-facing technologies, and therefore the portfolio has low exposure to consumer-facing sectors. Next slide, please. ESG and responsible investing is becoming a big part of our investment philosophy. Albion is a signatory to the United Nations Principles for Responsible Investing, UNPRI, and we incorporate environmental, social, and governance consideration into our investment decisions, and I will show you how we do that on the next slide. We have broken down our investment process in 5 phases. The first phase is screening for new companies to invest in. The second phase is our due diligence and assessment of those businesses and taking the investment decision. We then work with those companies over a number of years. Occasionally, we provide follow-on investments, or we enable the companies to source further investment from third parties. And the final stage is the sale or listing of the companies, which provides the exit from our investment. Across each of these stages, we use ESG criteria in how we operate. In the screening stage, we do not invest in certain sectors, most notably gambling, anything to do with tobacco or military type applications. During the due diligence phase, we typically make an assessment of the ESG policies of the companies that we invest in, and we create a plan as to how this can be improved, which we then apply and implement during the stewardship and monitoring phase, always looking for improvements year on year. We use specifically the opportunity that follow-on investments provide us to actually reevaluate those policies and procedures. And as we grow towards the to exit stage, we use the ESG policies, procedures, and considerations that we've built over the years to derive best value from the investments. Next slide, please. Albion itself is participating actively in a number of charitable activities which have an ESG component. The two charities we backed in the last year or so are WizKids and Generating Genius, both of them very exciting charities that provide, in the case of WizKids, young wheelchair users and young people with disabilities are given equipment provisions and given skills and training to become better employable. And in terms of Generating Genius, that charity backs talented students from disadvantaged backgrounds to inspire them to pursue STEM careers. We have raised funding through a number of activities over the years to donate to these charities, and we encourage shareholders to sign up to electronic communications, thereby making Albion donate £1 for every shareholder who signs up to electronic communications to one of these charities. Next slide, please. In terms of the prospects for the company going forward, I'd like to highlight the following. As I've described in this presentation, we back innovative, fast-growing companies, predominantly in the B2B software and digital health space. We have a clear specialism in the seed to Series B growth phases, which are very distinct phases where we add significant value to the companies we invest in. We help them attract and build talent in their talent base. We help them with their go-to-market strategies, and we help them with funding and financing strategies as well. There is continuing growth anticipated from the existing software and healthcare portfolio, which gives us a basis for optimism. And a strong pipeline is also present, and we find a number of new companies that we're pursuing in terms of potential new investments. We have a well-diversified portfolio, which has a component of stability around the renewable energy assets. And all of this with a medium to long-term outlooks gives us significant optimism that the company will continue to deliver attractive returns to shareholders. The first dividend of 0.87p per share and a special dividend of 1.5p per share will be payable at the end of this month on the 30th of November. Next slide, please. I would finally like to mention our top-up offers for the 2021-22 year. Our current intention is that the Albion VCTs will launch prospectus top-up offers of new ordinary shares for subscription in the 2021-22 year, as well as 22-23 tax years, and that this prospectus will be available in early January for shareholders to download from our website. Shareholders are encouraged to change their communication preferences to email rather than post, which will ensure that they receive the announcements of launch in the most timely manner, as well as ensure that they have sufficient time to participate in the early bird offer. In the past year, a number of investors who didn't receive communications electronically were disappointed by the early bird offer closing very, very quickly and them not being able to participate. We also encourage shareholders to follow Albion on LinkedIn for the latest updates and information regarding the offers, as well as updates on a number of the portfolio companies. Next slide, please. Well, this is the end of my presentation. I hope you found it informative. I look forward to any questions that you may have posted during this presentation. And I now pass back to our chair, Penny Freer, to lead us to the next session.
Thanks, Emil. I'll ask my board colleagues and also Will Fraser-Allen, the managing partner at Albion, to join me on screen, if I may. So we're now going to have a Q&A session. Some questions have been received from shareholders, and we'll answer as many of these as we can in the time that we have available. But just to let you know that all the relevant questions and the corresponding answers will be posted on the Albion Capital website following the meeting. So let's start with a question for Emil. Emil, how does Albion pick the winners that you've been seeing recently, that you've just been talking about?
We engage with companies over a long period of time, and a number of the companies that are now becoming the winners in our portfolio we've known for a very long period of time. Quantexa, the biggest investment in this portfolio, is a good case in point. We knew the founders for some time. We had followed the early stages of their development, and we backed the company quite early on because we got the confidence that they knew their market extremely well. They had previously been involved in businesses in the same industry and successfully so. And that gave us the confidence to back them and to continue backing them as they continue growing. So with Quantexa, even though in terms of time horizon, we've only been in the investment for 4 or 5 years, actually, in terms of the growth that the company has achieved over that period, it's been tremendous. And we've supported them at every stage of it. We've contributed at every stage of it. And despite the fact that they've raised hundreds of millions of dollars, we are still an active board member participating and contributing to their continuing development. So this is just one example.
And perhaps coming to you, Will, the portfolio, as we saw from Emil's presentation, is becoming more concentrated with 3 of the major investments accounting for 22%. Is this an opportunity for us, or is it also a risk? And if so, how do you mitigate against that?
That's a very good question, because one of the resultant effects of the strategy that we're now pursuing is that we will see greater concentration. And the reason for that, as Emil's slide demonstrated, is that we are very clear that we want to back the winners, and we want to back those businesses through multiple rounds of funding as they grow, such that they will become larger businesses and therefore represent a greater proportion of the NAV of the thing. So to answer the question specifically, it is both an opportunity and a risk. The risk is clearly a concentration one, which is that were one not to succeed, that would have a greater impact on the NAV. But to thinking more about the opportunity, what it's showing is that we've got some businesses that are growing very fast, becoming very substantial, and all things being equal, will continue to grow and become even more substantial businesses. I think the other useful point to make here, and an important point to make here, is that larger businesses should be less volatile. So if they're well run, well operated, and doing good things, that in itself should give rise to less volatility compared to, say, a portfolio full of very, very early stage, higher risk investments. So in summary, Penny, both an opportunity, but also a risk.
Thanks, Will. Emil, back to you. In your presentation, you showed us some of the investment realizations which have increased in value, and some very good disposals for the VCT. Were there any failures? And if so, can you just touch on those for us?
I'm pleased to say that there weren't any significant failures. There were a couple of companies, and we mentioned 1 or 2 of them on the slides, which found the trading environment very difficult during COVID for obvious reasons. I mean, principally because they were shut off from the customer base in many cases. But we years ago we took the decision to not really back consumer-facing businesses and to focus on business-to-business type companies, and I think that played very, very well during these unprecedented times that we had over the last 12 to 18 months. So actually, we look at the portfolio and we think that it's in good shape, and that the winners and those that are doing better are significantly outnumbering those that are not doing so well.
Thanks, Emil. And staying with you, what's the pipeline of new investments looking like at the moment?
The pipeline of new investments is looking really, really strong. It is a very strong pipeline, not just of new companies coming and looking for funding and looking for support from us, not just funding support, I hasten to say, but actually supporting scaling up across a number of kind of value-add elements. We also have visibility of additional funding required by a number of our portfolio companies who are continuing to grow. So this is funding that they need to continue growing at pace, which we're all also extremely happy to provide, because it's a measure of success, really. So we see ourselves, with strong demand for investment, both in the existing portfolio and in new companies that are looking for funding.
Thanks, Emil. Will, coming back to you, Emil mentioned ESG in his presentation. There's a question from one of our shareholders asking about whether there's a strategy in place to screen for investments in so-called green-orientated startups.
Right, Penny. Okay, so ESG clearly is becoming fundamental to what we do. But I suppose it's worth making the point that we've always believed that investing in companies that have a positive societal impact and environmental impact is a good thing and will give rise to longer term better returns. And I think to answer that question, one looks at the existing portfolio and the fact that we are very fortunate to have a chunk of renewable energy that we built up some years ago. But in terms of how do we develop that strategy described by our shareholders, a green strategy, I think it's important to look at the types of investments that we as a VCT can actively support. So we are absolutely on the lookout for interesting new technologies coming through. And as a side, we have exposure to some particular interesting businesses coming out of a fund we run for UCL. But in terms of identifying the right type of green technologies at the right stage of our development is the key at the moment. So yes, we are looking for them. Have we made it in the last year? No. Will we in the future? I very much hope so.
Thanks, Will. It's another question which I think should be for me. Please, could we provide some more detail on the performance fee which has been triggered for the year ending June 2021? So first of all, just to mention that this is the first performance fee that has been paid since 2007. We think it's an excellent way to incentivize the manager, and it's a very common method of incentivization throughout the industry. And we're delighted that this fee has been triggered, because what it means is that there's been excellent performance. And from the report and accounts that you'll have seen, if you look at the P&L, you can see there was a fee of just over 800,000 that was triggered. And this is on the basis of nearly 16% uplift in NAV. And at the beginning of the report and accounts, you'll see the tables which Emil also shared on his presentation of the 1 year, 3 year, 5 year and 10 year growth statistics. And what was behind that fee trigger was not only the 15.87%, as I say, for the year just gone, but 12% per year over the preceding 5 years and 7.5% per year over the previous 10 years. So we're delighted, and I hope that all shareholders should be delighted too. Right, another question for you, Will. Is the board concerned about the sunset clause in 2025? But perhaps you might explain what the sunset clause is as well before you answer that question.
Yes, no, absolutely. The sunset clause is enshrined within the VCT legislation, and it was introduced at the time when there was a European state aid approval back in, I think, 2015. Basically, what it said was that in getting state aid approval for VCTs, which we need because of the generous tax break you as shareholders received, they had to have a finite period for the scheme. So the sunset clause is simply the point in April 2025 when the scheme needs to either have that date extended or put onto a more permanent footing. So there is a process in place. There is a dialogue with Treasury going on where we are engaging to work with Treasury to see that sunset clause is either extended or the scheme made more permanent. And I think I know this is a conversation I've had with you as your board. I think what's really important here is demonstrating that VCTs are doing a good job for the UK economy. Are they and I think the evidence is very strong. Are they backing innovative growing businesses? Are they creating employment? And is that growth spread across the UK? And I think, and I'm very convinced that the answer to that is yes. And I'm confident that Treasury will recognise that and be supportive of the scheme.
Thanks, Will. Emil, coming to you for the next question. A shareholder has said that whilst his or her own investment strategy is that you make money the day you invest, i.e. the choice that you've made and the price that you've paid, how do you achieve the best exit prices and arrangements? Are we proactive? Are we reactive? Perhaps you could give some colour around that.
Yes, I mean, first of all, I agree that one of the major decisions is actually the investment decision, and picking the right businesses to invest in is the biggest driver of returns for the companies, which is why we spend so much time getting to know companies well before we invest in them. Having said that, we are very clear right from the beginning of our investment period with a company that we need to align ourselves on a strategy to an exit and how that's going to happen. And in some cases, founders and the companies and the markets they operate in lend themselves to growing a big business over a long period of time and looking for an IPO. In other cases, the best possible and most achievable exit may be a strategic acquisition from a larger player in the same space. We work extremely closely, almost from the beginning of our investment with these companies, to identify what the potential exit route might be, and what does that mean for what the company needs to look like at the time of an exit. What do they need to look like in terms of product development, in terms of size, in terms of geographical presence, etc., etc. Because we are very, very keen believers in the fact that companies don't get sold to get bought. But for the company to get bought, it needs to be on the radar of the right buyers, and it needs to fit with their own strategies going forward. I hope that answers the question.
Thank you. Thanks, Emil. Will, back to you. Why do we appear to be fundraising and conducting buybacks of shares in the same period?
Right. I think it's important to distinguish those two activities. If you look at a buyback, it is simply providing an exit for shareholders, and as shareholders may be familiar with, the only effective market is the VCT itself through its buybacks. So to enable shareholders to sell when they need to, and it's perfectly reasonable that people will want to sell, the VCT provides that mechanism, because effectively shares on the secondary market, there's very little activity on the secondary market because people hold the shares for a very long time. So we have to continue at all times to provide buybacks, and that's consistent across VCTs and the industry generally. So in terms of fundraising, I think fundraising is an assessment made by the board on an annual basis of what the cash requirements are for the company going forward. So that is all around an ambition to grow the fund, because clearly the larger the fund, the greater spread of costs across that asset base. Therefore, it's more efficient. But it also allows shareholders to increase their stake through their annual top-ups, and it ensures that we're able to balance that cash requirement between buybacks, paying dividends, making new investments. So inevitably, to be able to both grow a fund but also be able to provide a buyback facility, one needs to do both in the same year.
Thanks, Will. And Emil, coming to you, I think we've got time for a couple more questions. So coming to you, Emil, if a company IPOs, will you sell the stake, or can you hold listed equities too?
So if a company IPOs, we can hold our existing investment in the company for a number of years, which I believe is 5 years actually, while it's still being VCT qualifying. It really depends. It needs to be reevaluated on a situation by situation basis. So while the companies continue to grow and have strong prospects, growing in big markets, which themselves are growing with lots of tailwinds behind them, our preference will be to stay with the companies because we will know them well, and we'll be in a brilliant position to really evaluate the prospects and the ability to deliver further returns to our shareholders. So there is no one size fits all. We can be flexible within reason, and the legislation gives us the ability to stay with companies even when they get to the public markets for a period of time. Thanks,
Emil. And then finally, last question, Will, for you. Why are we holding so much cash in an increasingly inflationary period?
Right. The reason we hold cash is a question of liquidity. We need to make sure we've got sufficient cash to meet all the requirements of the VCT, as I alluded to in my earlier answer. Cash at 35% is higher than perhaps historically, and that reflects we had some significant exits in the year, notably the care homes, which was a very nice exit. But it's also actually looking forward, a reflection of what we can see coming in terms of opportunity within our own portfolio. So what we're creating is actually a portfolio of really, really very exciting businesses that are growing. And that is in line with our strategy that we want to back businesses that have significant ambition, that will require multiple rounds of funding, and we need to be well placed to do that. So if I sort of look at my sort of pipeline of follow-on investments, I can see some real demand coming, and for very good reason. These are businesses that are doing well. So I'm comfortable with having a higher level of cash at this point in time to reflect the fact that we can see some really interesting opportunities within the portfolio. And that's not to take away from our new deal activity as well, which through a very effective origination function, we can see some really interesting new investment opportunities. And it would not serve shareholders at all if we weren't in a position to benefit from those new investment opportunities as they came around.
Thanks, Will. Emma, Will, thank you both very much for joining us to answer those questions. As we said previously, any questions that haven't been answered this morning, we will make sure that we put them up on the website. There'll be a full list of all the Q&A so that you can see those later. So we're now going to proceed to the formal business of the AGM. My board colleagues will join me on screen. The notice convening the meeting has been in your hands for the statutory period, so I'll take the notice as read. There have been no questions from shareholders on the AGM resolutions, and therefore I'll proceed. For this AGM, shareholders at the place of meeting can vote on the proposed resolutions. Therefore, James, Pam, Ian and I, and all shareholders at the place of meeting are allowed to vote. However, you will shortly see that the proxy votes we've received show that the majority of shareholders have voted in favour of the board's resolutions. And I don't intend to read out the proxy votes after every resolution, but I will show them on the screen as each resolution comes up. The first resolution on the agenda is to receive and adopt the company's accounts for the year ended 30th of June 2021, together with the strategic report and the reports of the directors and auditor. Those in favour? Thank you. I declare the resolution carried. Resolution 2 is to approve the directors' remuneration report for the year ended 30th of June 2021. Those in favour? Thank you. I declare the resolution carried. For the next resolution, I will pass the chair to my board colleague, James Agnew.
Thank you, Penny. Resolution 3 is the re-election of Penny Freer as a director of the company, and I have pleasure in proposing Penny for election. Those in favour? Thank you. I declare the resolution carried. Penny.
Thank you, James. Resolution 4 is the re-election of James Agnew as a director of the company, and I have pleasure in proposing James for re-election. Those in favour? Thank you. I declare the resolution carried. Resolution 5 is the re-election of Pam Garside as a director of the company, and I have pleasure in proposing Pam for re-election. Those in favour? Thank you. I declare the resolution carried. Resolution 6 is the re-election of Ian Spence as a director of the company, and I have pleasure in proposing Ian for re-election. Those in favour? Thank you. I declare the resolution carried. Resolution 7 is the reappointment of BDO LLP as auditor of the company to hold office from the conclusion of the meeting to the conclusion of the next meeting at which the accounts are to be laid. Those in favour? Thank you. I declare the resolution carried. Resolution 8 is to authorise the directors to agree the auditor's remuneration. Those in favour? Thank you. I declare the resolution carried. Resolution 9 is to approve the continuation of the company as a venture capital trust. Those in favour? Thank you. I declare the resolution carried. Resolution 10 is a special resolution to amend Article 131 of the Articles of Association, which will allow the company to propose an ordinary resolution to remain a venture capital trust in the future. Those in favour? Thank you. I declare the resolution carried. Resolution 11 is an ordinary resolution to allow the directors to allot shares. Those in favour? Thank you. I declare the resolution carried. The penultimate resolution, again, is a special resolution that allows the directors to be empowered to disapply preemption rights. Those in favour? Thank you. I declare the resolution carried. And the final resolution, also being proposed as a special resolution, is to authorise the company to make one or more market purchases of ordinary shares in the capital of the company. Those in favour? Thank you. I declare the resolution carried. Thank you. That concludes the formal business of the AGM. I would like to thank all shareholders who have joined this live streaming of the AGM. As I indicated earlier, the board welcomes any feedback you may have, and you can do this by sending an email to me at crownchair@Albion Capital. For those of you who are interested in seeing the list of questions and their answers, as I mentioned earlier, they will be available shortly on the Albion website. The entire presentation will also be made available on the website, along with the manager's presentation and the formal business of the AGM. Thank you very much for joining us. This concludes the business of the AGM. I now formally close the meeting. On behalf of the board, I do hope you all stay safe and well. Thank you.